Now, Joseph Carlson is an investor as well as a content creator, and he regularly discusses his investing strategy, his outlook on the market, and how well his portfolio is performing. Now, in 2023, he outperformed the S&P 500, and in today's episode, we are going to take a look at 10 of his largest holdings in his portfolio, discuss whether we see any of them as undervalued. We'll look at their historical performance. We'll talk a little bit about their dividend safety. We'll talk about the dividend growth that each one of these have seen. And for each one, we will discuss our own intrinsic value, whether or not we see them as undervalued, and if we should be considering adding them ourselves. So the first one we're looking at is Mastercard Incorporated, where in fact we get a strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. Now, this is trading in the mid to upper end of the 52-week range. It does have a forward yield, although fairly trivial at 0.59%, and it does have a forward P sitting around 31.3. Bear in mind, S&P right now is around 23, and over the last 12 months, it is up around 13%. Over the last 10 years, this does not include dividends reinvested, you would be up 473%, and you would have massively outperformed the S&P during this 10-year period. Now, when we talk about this company's dividend safety, no surprise whatsoever, they get the highest score obtainable at 99. They also increase their dividend at double digits very consistently, which is what we love to see. 16% in the more recent increase, which was December 23. Hence, we are expecting another annual increase in December of 2024. Now, when we look at this company in terms of the valuation, as always on this channel, when we do our deep dives, we do take a look at every single one of these models and we discuss the inputs as well as the outputs. Today's episode, jumping straight in, our intrinsic value of $531 isn't dissimilar from Wall Street's forecast over the next year. They see upside of 18%. Now, as always, with the current price around 444, we always use a margin of safety. Now, at 10%, what we always do is execute on this if we believe it meets the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for today, well, you can see it is a buy around $478. We keep going till we see it's near the current trading price, and we can see it isn't at a 20% margin of safety just yet. It does sit somewhere between 15 to 20%, although it is leaning more towards the 15% margin of safety, with a nice respectable 18% upside from Wall Street, who do consider this a strong buy. Now, historically, when we've done a deep dive on Mastercard, it has some very, very high quality metrics. So in my opinion, a 15% MOS level isn't a bad place to start if this is one you do believe as high quality in the long-term portfolio. The next stock that we're moving on to is Apple. Now, this one, as we can see, a buy from Wall Street, although the other two analysts do give it a clear hold. It is trading right this minute at its 52-week high. In fact, its all-time high. It does have a yield, although very similar to Mastercard, fairly trivial at 0.44%, and it does have a forward P, again higher than Mastercard, sitting at 34.5. Now, over the last 12 months, it is up around 21%. It did recover quite quickly from the lows of not too long ago at around the $164 mark that we saw just months ago. Over the last 10 years, no surprises, you would have significantly outperformed the S&P 866%. Now, when we talk about this company, again, no surprises, a very safe dividend score. Reason for this with Mastercard and Apple so far, their free cash flow payout is very, very low. However, having said that, it's disappointing to see with Apple that their growth this year was 4.2%, which is pretty much essentially in line with that inflationary target that we always say to achieve as a minimum. One thing to note, they have recently become now the most valued company in the S&P, $3.49 trillion. Again, recently this share price was fairly low in comparison to the price today, but they have recaptured that number one spot. When we talk about this company, then in terms of the intrinsic value, we get a price of $208. Now, a few things to note that is interesting. Firstly, the current price is much higher. Therefore, we believe it is trading at a premium, which effectively means no margin of safety, not even a 5% margin of safety for those that do believe that is sufficient for a high quality company. You would have to wait around $198. At 10%, you would have to wait for around $187. So as we said, no margin of safety. And interestingly, Wall Street, they see the price target over the next 12 months at $221. upside -3%. So similarly, they do believe this is overvalued, which is interesting because when we do look at the ratings, they did call this a buy, which is why we always say to do your own due diligence, never copy what insiders, institutions say or perform. We then move on to Costco, which just continues to climb higher and higher. It defies completely everything around investing. It sits at a buy rating with Wall Street with a double hold from the other analysts. Again, similar to Apple, right now sitting at all-time highs. It trades at an incredible forward P of 55 with a forward yield below 1%, similar to the other companies so far. And over the last year, up 73%. Over the last 10 years, we can see another one that has significantly outperformed the S&P, up 756%. No surprises, another very safe dividend score. And while we do talk about this yield being very low, bear in mind every few years they will do a special dividend. They did one, in fact, at the beginning of this year in January, which was around $15 per share. As we can see, another feature of this company is their growth, double digits pretty much every single year, 14%, which is what we saw in April of 24. Now, when we talk about the valuation, very similar to Apple, we have an intrinsic value now that is lower than the current trading price. So we do see this trading at a premium. Pretty much the same to be said for Wall Street. They see -3 upside, effectively downside over the next 12 months. For those that are looking for even just a 5% MOS level, we can see your acceptable buy would be around $782. At 10%, as we can see, $741. So right now, no margin of safety, trading at a fair premium. We then move on to S&P Global, where we get a strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. Again, very similar trading right there towards its all-time highs at the 52-week range as well. The forward yield, 0.8%, forward P, 32.1, up 15% over the last 12 months. Over the last 10 years, another one that would have outperformed the S&P, up 454%. Now, we are pretty much on a roll today, another 99, very safe dividend score, although it is very disappointing to see a below inflationary increase this year at that 1.1%. Now, when we talk about this company's intrinsic value, and don't forget you can grab a copy of this model by clicking on that pinned comment below, running your own numbers through, we get to just under $500. So there is a margin of safety today at 10%, pretty much near the current trading price, not quite there yet, sitting somewhere between 5 to 10%, although more towards the 10% level. We can also see Wall Street do estimate upside of 9% with a price target not dissimilar from our intrinsic value of $499. We move on to the first one that actually doesn't pay a dividend. It is CMG Chipotle Mexican Grill. Now, they does have a buy rating from Wall Street, a double hold, a very high forward P sitting around 53.4. Bear in mind it had a very recent stock split, and whilst it is up around 41% over the last 12 months, we can see over the last 5 days it is down around 5%. When we talk about the last 10 years though, another outperformer of the S&P, up 391%. So let's get into the valuation, as there is no dividend safety score. We get to an intrinsic value of $51. We believe this is significantly overvalued, trading at a very large premium, but we can see we're in disagreement with Wall Street, who see upside of 13%. They have a price target of $67. Now, a 10% margin of safety would indicate a buy at around $46. And as always, do let us know your thoughts about these stocks. If you are looking to add any, maybe on the watch list, or in actual fact you are considering selling them, as a lot of them do seem to be trading above their intrinsic value. We then move on to Microsoft with another strong buy and a buy from Seeking Alpha. We get that hold from Quant, which seems to be very typical these days, and it is trading at its all-time or near enough all-time highs. Forward yield 0.64%, forward P just below 40, and over the last 12 months, well, it is up around 40%. Over the last 10 years, up 937%. Again, another strong outperformer of the S&P. Another very safe dividend score, and again, very typical with this company, double-digit increase, 10% we saw in September 23, so not too long ago to see that dividend increase. Very common theme in today's episode, we do see it trading above its intrinsic value, $464, so at a nice premium. But with Wall Street, there is a large disagreement. Their price forecast just under $500, upside of 7%. Again, for those that are looking at a 5% MOS, you would have to wait for $406. At 10%, $385. So quite common theme today. A lot of these we do see trading at a fairly large premium. We then move on to Moody's Corporation with a double buy Seeking Alpha Wall Street, a hold from Quant, trading near enough its 52-week and all-time high. Forward yield, well, just below 0.8%. Forward P, just below 40. Over the last 12 months, 27%. Over the last 10 years, again, another outperformer of the S&P. Dividend safety, not as high, but still very safe at 83. Nice to note this year that double-digit increase to the dividend February 24. When we talk about the intrinsic value, $423, we can see again trading at a premium. At a 5% margin of safety, you would have to wait for around $402. At 10%, around $381. As we can clearly see, Wall Street are in agreement, not dissimilar price targets and intrinsic value. They do see negative 3% downside over the next 12 months, and our intrinsic value, as we can see, currently sitting around $12 to $13 shy from that current price. We then move on to Texas Roadhouse with a double buy and a hold from Quant. Trading not too far from its all-time highs. It does have one of the high yields today at 1.42% and one of the lower forward P's at 29, again, still above the S&P. But when we look over the last 12 months, up 50% over the last 10 years, up 570%, again, another outperformer of the S&P. Talking about dividend safety, well, it gets the 80 score, so it is safe. And we do also note that double-digit increase in February, 11% to the dividend, things we do love to see. Now, intrinsic value, whilst we do see it up above the current price, it is only marginal, so you're not even looking at a 5% MOS. It isn't too far though, so again, as we can see, for those that are looking at that 10% level, you would have to wait for around $158, and we can see Wall Street are in a rough agreement. They see upside of 1%, their price target $172. Now, just to let you know, we have released our latest free weekly article. We run through 18 undervalued dividend kings, and with this article, you do get a free spreadsheet running through all of them and the price targets that we have. If you want access to this or any others, it is all completely free. You can click on the pinned comment below to read, sign up straight away with that instant access. Next one we're looking at is Amazon, that is having a hard time cracking the $200 barrier. Again, it is a strong buy from Wall Street and a buy from Seeking Alpha, a hold from Quant, and as we can see, $201 the all-time high. Forward P, 44, so again, we are noting a lot of these are trading very high. In terms of their performance, up 57% over the last 12 months. Over the last 10 years, up 1,015%, very, very strong. Now, as they don't pay currently a dividend, we'll jump straight into our intrinsic value. And if you want to understand where this number comes from, well, we did recently, just over the last few days, do a deep dive on Amazon, so do check that out. So we do see it trading at a marginal premium, although a lot of that will depend on how they are able to quickly increase their free cash flows, and that is something that we are seeing with them moving forwards. A 5% MOS level, well, you'd have to wait around 176. At 10%, around 166, again trading at a premium. Although Wall Street are essentially in the view that there is 11% upside, their price target $222. This then takes us on to Netflix, where we get a buy rating from Wall Street, a double hold. We're seeing it trade at its all-time highs with a forward P sitting around 37.39. Over the last 12 months, up 57%. Over the last 10 years, as we can see, up over 1,000%, where it was essentially trading around $700 in 2021 before falling down to below $200 and recovering very, very strongly. So in terms of the valuation, again, this one doesn't currently pay a dividend. We get a price of around $660 using the DCF model, and we can pretty much see right now we again believe this is trading at a premium. 5% margin of safety, well, you'd have to wait for around 627. At 10%, around just under $600. And we can clearly see Wall Street are in agreement. We have very similar targets and intrinsic values. They see downside of negative 4% with their price target around $660, $30 shy from the current value. As always, let us know your thoughts on these 10 stocks, whether you're looking to add any of these, maybe you're there on the watch list, or you do believe their valuations are getting a little bit out of hand. A lot of them are sitting, if not the majority, at all-time highs with P valuations well above 30, 35. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and we'll see you all on the next one.